Hi, this is Marcellus Duffy with the Duffy team at Berkshire Hathaway Home Service Alliance Real Estate. And I am here with Addison Meyer at USA Mortgage. And there's a couple of things we want to talk about today. One is getting great quotes and what effect that has on my credit. So, Addison, it's my understanding that when I'm got a buyer looking to buy a house, that if they call you, they can also call some other lender as well. And that won't have an impact against their credit. Is that correct?
That is correct. Per Dodd-Frank, when that act was initiated, you can have as many credit pulls as you would like from a mortgage company, mortgage related, within the first 30 days of the initial pull, in order to encourage you to shop rates for other companies. That protects you from your credit score. On the other side is any hard inquiry that takes place, such as a credit pull, will fall off your credit report, affecting your score within 120 days. And typically the effect is not as detrimental as you may believe. As long as you're not pulling 60 times, 10 times, 15 times, the hit's going to be minimal at cost, if anything. Okay.
So if I do have somebody that calls you and gets a quote from you and calls somebody else and gets a quote from them, is there
As always, make sure you're comparing apples to apples. In a lot of situations, what you're going to see from mortgage lenders that are out there is they are going to inform you of the current day's interest rate. If they haven't checked your credit score, haven't checked the criteria of the loan, they're going to inform you based off of what the best day's interest rate is. And that's typically an FHA loan with a buyer that's over a 740 plus credit score with a down payment of a minimum of 10%. Okay. That is at a debt to income back end ratio of about 20 to 30%. So when you're comparing those through it, make sure that you've got the right loan type being qualified, the right down payment amount, and also make sure that you're qualifying based off of the correct credit score.
Okay. Now, is it possible that somebody might see an interest rate and get excited, and undeservingly so?
As always, in the fine print of any type of mortgage material that's out there revolving around interest rates, you will always run into companies that want to present the best information out there. I can go around and say an FHA loan's at 4.75% with these criteria. All mortgage companies have that out there, and it's required to be disclosed on any type of their advertisement, print, paper, radio, so on and so forth. The tiny print really comes to get you quite a bit.
Okay. Should I be aware of what I think is a really low rate? So I've shopped 3 different lenders, and one of the lenders is maybe 2/10 or maybe even a quarter lower than the other 2. Is there a reason? I mean, could it be that I'm having to pay for that some way?
Correct. On your original, what's called your loan estimate, which is a document that is disclosed to you by the lender, and is required to be disclosed within 3 business days of completion of the contract, they will have what's called origination fees or charges for the rate. It's also known as buying down points. Okay, and what they do is they put a fee in there that is a percentage of the total loan amount, and they charge that to you, and it will be showing on that initial fee cost, that initial disclosure process, and anything that takes place on that loan estimate. The only thing on the loan estimate that cannot adjust, meaning it cannot change per any amount, is the origination charges that are provided by the lender, because you have no capability to shop those rates, shop those fees with that lender. So the origination charges are usually included in another section, and if they are disclosed, that's what they're charging you.
Gotcha. Okay, thanks.